All right, let's jump right in and break down the ZedXE Global Economics and Markets update and really figure out what the key signals were as of late February 2026. You know, if you had to boil everything down into one sentence, this quote just nails it. The global economy is in this massive tug of war, with all these powerful forces pulling in completely different directions. So let's get into it. What was really going on behind the scenes for the economy and for the markets as we were about to flip the calendar over to March? Okay, first up, let's talk about the foundation, the big picture view for global growth. And honestly, the main story here is just how surprisingly resilient everything has been. I mean, take a look at this. All the big players, we're talking the IMF, the World Bank, S&P, they're all pointing to pretty steady, moderate growth for the year. The numbers aren't identical, of course, but the message is loud and clear. The global economy is hanging in there. And this is where it gets really interesting. This slide shows that economic tug-of-war I was talking about. On one side, you've got these huge boosts, like a ton of money pouring into AI and governments keeping the spending taps on. But on the other side, you have these major drags, right? High interest rates are still biting, and there's a lot of geopolitical tension simmering. And you can see how this push and pull is playing out so differently all over the world. The US is just the clear outperformer here at 2.2%, really thanks to strong consumer spending and that AI boom. Then you look at the euro area, much slower growth. The real powerhouse for this year, it's the developing economies, which are forecast to grow by a really solid 4%. Okay, let's shift gears and talk about the second massive piece of this puzzle, inflation. Because what's happening here is really setting the stage for some huge policy decisions worldwide. And on this front, the news has been overwhelmingly good. In the US, inflation has cooled off in a big way, dropping to a much more comfortable 2.4% back in January. Go across the Atlantic, and the story gets even better. The euro area saw its inflation dip all the way to 1.7%. I mean, that's actually below what the central bank is even aiming for. And yeah, the UK's rate is a little higher, a bit stickier at 3%, but it's also clearly heading in the right direction. It's on a good path to hit its own target pretty soon. So, what's the bottom line? The really crucial point. It's that the global inflation beast is, well, it's finally getting back in its cage. And this is huge. This gives central banks the breathing room, the flexibility they've been waiting for to maybe stop focusing so much on fighting inflation and start thinking more about supporting growth. So, with growth holding steady and inflation coming down, how are the big central banks around the world responding to all this? Well, if you had to pick one word, it would be cautiously. For the most part, everybody just hit the pause button. The US Fed, the European Central Bank, the Bank of England, they all decided to just hold rates steady. They're basically in full-on wait-and-see mode, just watching the data roll in before they make their next big move. But not everyone was reading from the same playbook. There was one big exception to this global pause, and that was down under. The Reserve Bank of Australia actually raised its key interest rate to 3.85%. They were dealing with some surprisingly strong inflation and consumer demand in their own backyard. It's just a great reminder that even in this super connected global economy, a lot of these decisions are still very much local. Okay, so that's the economic setup. Now let's get to the fun part. How did all of this actually translate into performance for investors in these stock and commodity markets? In the short term, the mood was all about nerves. Seriously. Despite all that solid economic data, there was a sharp sell-off late in the month that really hit the markets hard. This Reuters headline just sums it up perfectly. People got spooked by fears of new AI regulations and the idea that trade tariffs might be coming back. But, and this is so important, you have to zoom out. That short-term volatility, it completely masks the incredibly powerful longer-term story. Just look at the tech-heavy Nasdaq. Even with those recent jitters, it was still up a staggering 28.3% over the last year. The AI boom is still the dominant force driving returns, period. Over in the world of commodities, it was a tale of two completely different markets. Geopolitical worries helped push crude oil prices up almost 16% for the year. But at the exact same time, there was so much supply of natural gas that its price actually fell. It's just another perfect snapshot of those diverging forces we keep talking about. So, where does all of this leave us? What are the key things that you should really be keeping an eye on for the month ahead? Okay, as we head into March, all eyes are going to be on these key things. The next US Fed meeting is going to be absolutely crucial for any clues about future rate cuts. The inflation and jobs reports, of course, have the power to move markets instantly. And we'll be watching really closely for any new chatter on AI regulations and those very delicate trade talks between the US and China. Which really brings us to the ultimate question for the rest of the year, doesn't it? The entire global economy feels like it's walking this tightrope, trying to balance the incredible, massive promise of an AI-driven boom on one side against the constant, unpredictable risks of a geopolitical bust on the other. Which one of these powerful stories is going to win out? Well, that's what's going to define 2026.